Welcome to the Renee Lobo Report, bringing you issues of topical interest. Welcome to the Renee Lobo Report, bringing you issues of topical interest. Hello everyone, I'm Renee Lobo and welcome to the Renee Report, bringing you issues of topical interest. Today we're going to be talking about the tax landscape for 2013. What's going to happen? Is a fiscal cliff going to be taken care of? Because the Bush tax cuts will expire December 31st of 2012. What happens then? Will the taxes go up? And this is very important for low-income and middle-class families. My 2K, we're going to talk about that as well, and how the Affordable Health Care Act, when it kicks in 2014, how does it impact our taxes? And we're going to talk about this to our tax consultants. They're going to be giving us tips and advice and what they see in their bowl for the future, crystal ball. So let's talk to Cecil Nazareth, who's a chartered accountant, as well as Vinay Navani, who's a CPA with the tax firm of Wilkin Guttenplan. Thank you, gentlemen, and welcome back. We had talked last time about year-end tax planning for 2012 and, the tips and advice and the best ways to get the best bang for your buck. Let's talk about the changing tax landscape for 2013, especially with the fiscal cliff looming so, right in front of our face because the Bush tax cuts are expiring end of this year. What do you see for the future of our taxpayers?
Well, the future actually, in a sense, is very clear because the way the law is written, we know what's going to happen. Tax rates are going up, generally speaking, across the board.
Right.
All the talk about the fiscal cliff is trying to come to a compromise so that that doesn't happen. But not to be pessimistic, but the one thing that Congress has shown is they frequently disagree and they frequently cannot come to an agreement. So if they don't come to an agreement, we know exactly what's going to happen.
So partisan politics are going to impact adversely the taxpayers.
Correct. If an agreement cannot be reached, yes, we know.
Now, we need the agreement before January 1st?
January 1st, the sooner the better, right? Because nobody knows how to plan for next year. There's important tax planning techniques that people want to do at the end of 2012 that are absolutely impacted by what's going to happen to the tax rates in the future.
Right.
Also, the later the tax law is ultimately settled, means the later people can file. So people who file in January because they get tax refunds, they need those tax refunds, are not going to be able to file as early, and they're the ones going to be impacted probably the most because it takes the IRS time to reprogram computers, reissue tax forms, and it's going to push that filing deadline or the earliest opportunities to file back by weeks.
I see. Cecil, what's your take on this?
Yeah, one thing for sure, taxes are going to go up. Tax rates are going to go up. So that's a certainty, whether they compromise or they don't compromise. If they compromise, it may be a little lower, but if they don't compromise, like Vinay suggested, you're talking of the rates going back up to 39.6%. That's a given. So that point. And if you notice, the media has been all hovering around this. The stock market is up and down, all because of uncertainty, the word called uncertainty. And same thing happens in tax law. You cannot do great planning if you don't know what the tax rates are going to be and how it's going to affect you as a person. So we're talking of tax rates are going up, we're talking of capital gains tax rates are going up, we're talking of Medicare tax rates are going up, we're talking of payroll tax rates, estate and gift tax. So everything looks like a pretty dismal picture right here with everything, tax rates are going up for everyone. You don't see a compromise. Let's start with, if there is a compromise, what does the picture look like for 2013? I would say the quick one on the payroll taxes, I have a strong feeling. Now this is just a feeling because the current rate of payroll taxes, especially for the employee FICA tax, they reduced it from 6.2 to 4.2.
Right.
Lots of people didn't realize they got an extra $200 in their paycheck all these past 2 years, but the party's over. So if they don't come up with that compromise, then you're talking it goes back to 6.2%. And I don't think they'll do that because that might have economic impacts well beyond affecting the recession or a double-dip recession, because that 2% is significant for all tax levels, irrespective of tax rates going up.
Right.
So I think on the payroll tax side, I have reasonable comfort that they might compromise and at least extend it another year.
Okay.
We don't know beyond 13, but for 2013, I think they might agree with that. Okay. But on all the other ones, I'm really not sure on the rates going up or the estate and gift tax, and as we go through the, we'll get to. But I'm positive they're going up, except for the payroll taxes. I feel they may be compromised.
That's the only one that you think is going to be, so you're pretty much optimistic about that one.
That's
but
correct.
The others you're not very sure about. Now, we know that Bush tax cut era, the party's over. 2012, they expire December 31st. And you talked about it that, those are looking for their, little bit checks coming back from the IRS in January. Mm-hmm. That's not going to happen so fast, even if they start making a compromise. So what happens starting in January if there is no compromise?
Sure. So what's going to happen is all the tax rates are going back. Well, let me take a step back. In 2003, we had this legislation that came in and caused a across-the-board reduction in tax rates.
Right.
So that automatically expires December 31st, 2012. So we go back to those levels. And it's based on your level of income, right? So not the top bracket at approximately $380,000 of income goes from 35 to 39%, okay? But even on all the lower brackets too, they go all up by 2 to 3% across the board. So everybody's paying more of an income tax when they file their tax return. And it's going to impact, they're going to have more taxes withheld.
Okay.
So it's going to have a very immediate cash increase. And this is completely separate from the Social Security tax that Cecil just mentioned. This is going to have a direct impact on people's withholding. That's the income tax side. Okay. Now, there's many retired people that live off of dividends.
Right.
And under that 2003 law, dividends got a new unique tax treatment, that they were taxed at a maximum rate of 15%. Okay. That special unique tax treatment is also going away. So people, who, especially retired people who that was their primary source of income, all taxed at 15%, now that is lumped in with their other taxable income, and it's taxed at whatever their ordinary rate is. So some of those people are seeing a tremendous increase because they were already at 15%. Now they could be going up to 30+%, depending on where they are in their brackets.
Right.
People who sold stock held it for, the government wanted us to make a long-term investment in companies. If you held stock and held it for at least a year and sold it, you pay tax at 15%.
Right.
So that's going away, and it's going back to the 20% that it used to be. Okay. So not as bad of an increase, but that's still an increase to where it was.
So let's say they did come to a compromise maybe 20 days later, January 20th or something. Mm-hmm. What happens in those 20 days when the Bush tax cuts are out and the 2003 taxes come back?
Chances are Congress will make the law change retroactively to January 1st, 2013. The problem is going to be on the administrative side with the IRS. How soon will it take them to retool, reprogram their computers to be able to accept returns?
Oh, so the computer's going to go back to 2003 taxes.
Well, they're going to, whenever the law changes, then the IRS programmers have to reprogram everything, change the forms.
To 2013 again, new changes.
Exactly.
So it looks like a pretty, difficult way of going through this. The fiscal cliff is not that easy to resolve at this point of time.
No, both in terms of the substance, keeping taxes as low as possible, as well as the administration of the tax law.
Right. I mean, like Cecil did talk about payroll taxes, may not see much of a change, but there could be income tax, and then we're talking of capital gains taxes also going up?
Correct. And all that has to be reflected in the IRS forms and computers. But more importantly, if I'm here into 2012, I need to know whether I'm going to have a higher capital gains tax next year or a higher income tax next year. Because
so how am I going to be planning then this way? It's very hard to plan.
It's very hard to plan. People have to make their own decisions what they think is going to happen. So some people think that, okay, capital gains rates are going to be higher next year, so if I have a stock that's gone up in value, I'm going to sell it now, pay my tax on the gain. Maybe I'll buy that same stock back and hold it. Other people think, okay, well, I don't think they're going to raise the capital gains tax, so I'm not going to sell a stock today and pay tax any sooner than I need to.
Yeah.
There's no right answer. It depends on what you believe. So
what are the winds of change? Can you speculate from where we're going? I mean, at this point in time?
All of the political discussion seems to be centered upon how broad are the tax cuts, right? So the Obama administration has targeted this $200,000 or $250,000 level of income,
right.
Which is kind of the line in the sand. Right. And that's the disconnect between the Republicans and the Democrats as to how broad the tax cuts should be.
Okay.
So how it's resolved is anybody's guess.
So what happens when we talk about My 2K? And we're hearing this all the time. There's this whole thing about My 2K. The spin is on. What's happening with My 2K?
The two areas, I think, Renee, that we commented on the payroll tax cut, but there's AMT also.
Right.
It's called alternative minimum tax. That thresholds are going to come down. And as soon as those thresholds come down, there are more people at the middle income or lower level income who are going to get affected by that. So that's what they're referring to. Indirectly, their taxes went up. And they'll have less money in their paycheck. Take-home pay will be reduced. And if every family, if the rates go up or AMT, either from AMT or payroll taxes, you have less money to spend. Right. That has an impact on the recession.
It might be 1K, not 2K, because
it could
the payroll
be any
tax
K.
may not.
It could be any K. The bottom line is when you have less take-home pay, the consumers spend less, and it's also a thought process that they become more conservative, and that creates a downward spiral. It creates an economic uncertainty. And so I have a strong feeling whatever they do, the AMT patch and the payroll taxes, it will affect middle classes and also the economy, and that could send the whole world into a tailspin. Right. Because already the economy worldwide has not kept pace.
The Eurozone.
Absolutely. Eurozone, China has been down. So worldwide, I think, in my opinion, they will at least at the lower levels try some compromise that they keep the spending power intact without affecting those people. But the real battle is going on the above, like Vinay commented, above 250 and above $1 million. The real fights are taking place at that level.
And what about these state gift tax rates? They're going to go up too?
Yes.
They're going up.
They're going up anyways?
Well, it's the same thing. That was part of the law that's changing. It's going back to the way the law was in 2003.
Right.
And the estate tax rates are going from 35% to 55%, and the amount that you could give tax-free upon your death is going from just over $5 million back to $1 million. So people with significant estates are being impacted. And
there's one more comment, Vinay, if I could add. I think the portability exemption, what used to happen is a husband and wife. So if you didn't use an exemption, the wife could carry that exemption or vice versa on an estate tax. But if that portability goes away, that means you are restricted to just your deduction, you are in trouble. So that estate tax, in my opinion, is a killer. You're talking 35 to 55, and if you take away the portability issue, then your exemption is down, your tax rate is really going to jump for. So high net wealth individuals have a real challenge, and the estate planning becomes all the more critical in the next few